All right, welcome back. Now, we already have a great strategy for a bull market, for going long, but when the markets are not so bullish, what are we going to do? Well, the 20/20 is a long-only strategy. It's probably not going to work very well in bear markets. This is something that people need to consider when they're trading. If you're just using one strategy all the time, it might not always be the optimal time to use that strategy. In a bear market, what I do is reverse the 20/20 to search for candidates for stocks to sell short. The reverse 20/20 searches for cash poor, overvalued, slow growth stocks. Now, the first criteria remains the same. Market cap must be greater than $1 billion. We're going to be selling these stocks short. We still need liquid shares. We can't have an illiquid stock. But what we want is a 5-year revenue growth rate that is under 20%. We want a PE ratio that is over 20. So we want a decent sized company with slower growth that is overvalued. And we want a current ratio of less than 1. So we want the company to be cash poor or have trouble meeting its debts. There's no minimum requirement for institutional holdings in the reverse 20/20. So we run that screen and we get a great list of fundamentally weak companies that may be good shorting candidates, but we're not just simply going to sell them short. First, we go to the charts. And out of this field of candidates, we found a number of great trading opportunities. We found a double top with a second chance. We found a descending triangle within a downtrend. Several of those, in fact. Here's a head and shoulders breakdown with a second chance to sell short. A double top that fell apart rather quickly. Here's a triple top that was just breaking down as we ran the screen. And the great thing about this that I want you to keep in mind is this. When you're in a bull market, you're running the 20/20. When you're in a bear market, you're running the reverse 20/20. There are going to be times when you're not really sure if you're in a bull market or a bear market. It's going to happen. You could certainly have long positions that are created from the 20/20 and short positions that are created from the reverse 20/20 and hold those positions simultaneously. Now you're trading like a hedge fund. You're actually hedged, long and short, but you're long candidates that have good fundamentals and bullish charts, and you're short companies that have poor fundamentals and weak-looking charts. Now you're trading like a hedge fund.